Marginal costing. This is the third costing technique which we are learning, and the first two costing techniques are primarily used to work out the total cost of a product or a service. Although activity-based costing is being used in decision making with a slightly different perspective, and this technique, marginal costing, is generally not so good for calculating the total cost of the product, but it's widely used in decision-making process. This is more of a decision-making technique than the costing technique, but there are ways when we can actually use marginal costing as a costing technique as well. The word itself, those students from economics might be more aware of the word marginal. Marginal is additional costing, basically. So we'll talk about this this marginal aspects of it. And the most important concept in marginal costing is the concept of contribution. So I will explain this concept, and we'll work out the use of this. The another important area which we are going to look at using the same contribution concept is limiting factors and scarce resources. And this is a situation where one of the production factors, material, labor, or maybe machinery, is in limited supply, and we have to work out which one is the best option, or what is called optimal production plan. So we'll talk about these two areas. Other uses of CVP concept, effective change in volume. So what would happen if our sales drop by 10% or if our sales increase by 10%? We can work that out. Calculate break-even point. A key figure for any business. A break-even point is a point where an organization is not making a loss, neither a profit, or where the total costs are equal total revenues. So these are the two widely accepted definitions. Margin of safety is the concept which tells us that if our break-even point is 10,000 units and our target sales is 12,000 units, our margin of safety is 2,000 units. So how much extra we can sell before we go into loss? So our margin of safety, that is 20% margin of safety in percentage. Effective change in selling price, variable cost, fixed cost. One very important figure from a practical point of view is how much do we need to sell to achieve a certain profit. Combination of the above. A few formulas worth remembering. A formula sheet will not be given in the exam, so you have to remember these formulas. The first one is contribution to sales ratio, and that's simply contribution divided by sales figure. The other one is to find out break-even point in units. So fixed cost divided by contribution per unit. So if your fixed costs are, let's say, 100,000 and your contribution per unit is 10, then break-even point in units is 10,000 units. Margin of safety, we can ask you to give us margin of safety in absolute numbers. So for example, your break-even point is 10,000 and your target sales are 12,000. What is the margin of safety? That is the difference between target sales or achievable sales minus BP. So that's 2,000 units. Or it could be in absolute terms, which would mean 2,000 divided by our break-even point, and that would be equal to our percentage figure. Target profit, how to get this one? Fixed cost plus required profit divided by contribution per unit. So these are the four formulas. Another formula which is worth remembering is this one, which doesn't take into account per unit, but maybe the total figures. So if you want to find out break-even sales value, and per unit information is not available, in that case you have to use the total figures. So the total fixed cost divided by total contribution times total sales would give you the sales value which we need to break even. This is the break even chart. I have given this chart in exams a couple of times, and to ask you to identify what different things are. So I've asked students to say what is this point of intersection, what this curve, which let's say curve B means, what the curve C means, and what the curve D means, and what is the profit area, and so on. So I could ask these questions in exam to check if you understand this chart or not. Our variable cost is sitting on top of fixed cost. When variable cost is sitting on top of fixed cost, then it will become a total cost curve. The point where these two curves, total revenue and total cost, intersect, that is the point where our total costs are equal to our total revenue, and that means it's a break-even point. So you may have to identify that what is the break-even point in this situation. It's more easier to do on the graph paper, but we will not be asking you to create charts on the graph paper in the exam. So there will be no graph paper provided in the exam. Neither you would need